Even when we reach a period of pessimism, the potential unraveling in terms of perceived wealth is much greater this time than it will have ever been before. I think since I said that, we could take out the rivaling 1929 and 2000. I think we've gone way past that. There are examples of large-scale craziness and meme investing, etc., for which there is simply no parallel in 1929 even, or 2000. 2000 had pet.coms, and they were kind of glorious, but they were scores of millions or a few hundred million. We have crazy things now that are billions, and in some cases, we were the most impressive speculation, I think. There is nothing like that at scale, even adjusted for current dollars in 1929. And we are down 80%, which is a fairly fearful decline, but along with us, the next tier speculative stocks also came down. The SPAC index is down over 20%.
So doesn't that tell you that the market is essentially kind of a self-correcting mechanism? I mean, you're still ahead of the game with the investment, right? Doesn't that encourage you that in fact that the market kind of recognizes that these extremes have been reached and that we are seeing a correction in some of the most speculative parts of the market?
I think you've nailed it. The market is a self-correcting mechanism, but it's a little wonky in the time it takes. Sometimes it corrects pretty quickly, and sometimes it corrects incredibly slowly, and that's the problem. But if you go back to 2000, which is the previous leader in speculation, let's say, what happened there is the market peaked in March of 2000. And between March and September, pet.coms basically went out of business. The internet stocks basically went down 80%, but the whole .com, the whole TMT bubble burst, and the industry, which had been 30% of the market, declined by 50%. Right. The S&P was unchanged. And you could have said during that 5-month, 6-month window, oh, isn't that healthy? They're selling the flakiest pet.coms. They're buying Coca-Cola. What's not to like about that? That's exactly what happened. And I like to think of them as the kind of pessimism termites. And they ate through the craziest first, and then the junior growth stocks, and then the intermediate growth stocks, and then finally Cisco, which was for 8 minutes or so the biggest company in the world by market cap. And they were all down collectively 50%. And so for the S&P to be flat in September, it meant that the balance of the market was up 17%. So that looked incredibly healthy, but then the termites reached the broad market, and the entire 70% rolled over and fell 50% in 2 years. And the NASDAQ was down 82%. The thing about the underpinnings is they always look terrific. In 1929, the market didn't peak when they thought the underpinnings were terrible. They peaked when the market's enthusiasm for the underpinnings was approximately the highest it had ever been in history. In 2000, in March, the world uniformly, including the boss of the Federal Reserve, Alan Greenspan, they all thought the system had never been better. At the top of the housing bubble in 2007, Bernanke and the boys thought the US housing market had never declined, unquote. It merely reflected a strong US economy. The underpinnings were great. They have never gotten it right. The Federal Reserve in particular has never had a clue about asset bubbles. It doesn't even address it. They act as if they don't exist, except on the upside, they occasionally take credit for the wealth effect helping the economy along. And it does. Right. There is an income effect, and it does help the economy along. And Greenspan, Bernanke, and Yellen all took credit explicitly for helping the economy along. What they never did is they never took discredit for the reverse side. The market is mean reverting mechanism, and eventually it goes back to a fair price. And when it went back in 2001, 2002, it had a dreadful negative income effect. When the housing market collapsed and it took the equity market with it, it had a double-pronged negative effect on the economy. So it had a much bigger impact on the economy than had occurred in 2000. And this time, we're really playing with fire because this time, unlike 2000, we have an overpriced bond market. Jim Grant would argue the most overpriced in 4,000 years.
Right.
We have, in my opinion, and that of many other bubble students, the most overpriced US equity market in history. We have a housing market that 3 weeks ago reached the same multiple of median family income as it did in 2006 at the peak of the housing bubble. And we have commodities that have recently run amok, so that the Goldman Sachs index of non-energy, which is food and metals, which are pretty important, have just equaled the peak of 2011, which was said to be one of those super cycle commodity events. So
Right.
this is the first time we've ever risked 3.5 asset classes bubbling at the same time. If and when we reach a period of pessimism, the potential unraveling in terms of perceived wealth is much greater this time than it will have ever been before.
You quoted Robert Shiller, Nobel Prize-winning economist, about the fact that, that he said that even though his indices are showing the market, at extreme valuations, that really when you compare it to the bond market, which, as you said, is very expensive, that stocks don't seem so overpriced. What is your response to those kinds of arguments?
I think the interest rate argument is an explanation of how we get there in behavioral terms. It is not by any stretch of the imagination a justification. You don't justify anything by taking the most overpriced asset in the history of man, the bond market,
Right.
and saying compared to that, we are merely very overpriced and therefore relatively cheaper. That is very cold comfort. Solomon Brothers, an important firm at the time in 1989, sent around a hit squad justifying the Japanese stock market, which was approaching 65 times earnings, we were told at the time. The data was represented as 65 times earnings. It had never previously sold over 25. So that was, to say the least, the real McCoy. And this team went around pointing out that the rates in Japan were so low that 100 PE would be fair. Of course, the collapse that followed in land and bonds and stocks was cosmic. And there,
in 1989, and it still hasn't recovered.
it still hasn't reached the 1989 level in either their real estate market or their stock market. Reminds us of the cardinal rule, and that is, the bigger the bubble, the most ingenious the argument. And the bigger the bubble, the most extended and painful the decline.
There is a thesis, I'm sure you've heard it, that Tina, there is no alternative. And so again, because, for most money managers, for most individual retirement accounts, the choices have traditionally been stocks and bonds, some mix of the two. And therefore, if bonds are, if interest rates are at zero, that stocks look pretty attractive as an alternative. So, what is the alternative? Is there no alternatives to stocks for long-term investors?
That argument is pretty easy to get one's brain around. This is the most broad, as I said, asset bubble of all time, with 3.5 of the 4 major asset classes clearly in severe bubble territory.
Right.
And thinking that you have no alternative but pick between one of the 4 bubbles is a pretty grim way to view life. I get the argument, so pick a bubble, they'll all go together probably, and you will suffer a lot of pain. And the intellectual content of that argument, that they were all bubbles so we had to pick the least bad one, will resonate in your head as the market unravels. 12 to 15 years of flat market with earnings doing okay and rotation within the market, everything would work out fine. And every portfolio manager I almost ever met has felt in market bubbles that could happen. It just never does. The market abhors long sideways movements, as we all know. It either goes up more than you think or down more than you think. You can always hold out hope for an extended sideways movement, but it never seems to arrive. Let me just say, by the way, I have enormous sympathy for participating in a bubble.
Right.
When I was young in 1968, 69, we had a spectacular mini bubble in tiny stocks, and they all quadrupled and made us rich, and then they all blew up together, and most of them went out of business. And I was just out of business school, and I made a small fortune, almost enough to think about retiring to England. And then in the space of about 9 months, I lost everything back to $2,000 and was lucky to cover my leverage and get out without a huge debt. It was thoroughly exciting, probably the most exciting time I've ever had in investing. So I completely sympathize. Nobody who is young and investing and making money is going to listen to some old codger tell his war stories about when he got wiped out. I get that. So there's nothing that I can say that will cause anyone to change their behavior. The power, the psychological power of a bubble to suck everybody in is prodigious. And we've known that since the tulip bubble. And it will never stop.
But there are ways to handle it, and that's what I'm going to get to next. In my introduction to you, I mentioned a number of kind of prescient calls that you have made over the years. One of them, of course, was calling the market bottom in March of 2009, basically to the day. And you wrote a piece entitled Reinvesting When Terrified, telling clients to get back in the market at that point. At this juncture, it seems like we are in exactly the opposite situation. Should you be, writing a piece de-investing or disinvesting when terrified? And what do you recommend for individual investors who maybe aren't that young and would suffer terrible consequences long term from the bursting of these bubbles?
You suggest to me an interesting title, Disinvesting When Euphoric.
That's a better title than I came up with. Yes, Disinvesting When Euphoric.
It feels as psychologically difficult as reinvesting when terrified. They both catch the spirit of the exercise. Well,
right.
I would look around and ask the question, what is the least bad? And the least bad is emerging markets. It's a little overpriced, absolutely, but it is at one of its 3 points of maximum difference to the S&P 500. And each of the other two examples worked out wonderfully well in favor of emerging markets. Conversely, when emerging markets was at a peak, which it was in 07, it sold at a premium PE to the S&P, you can have very bad things happen, which they did. But emerging markets is relatively very cheap and pretty much close to fair value. And the other thing is value versus growth. Low growth stocks have been pummeled by high growth stocks for the decade ending in 2019. And then in the year 2020, they had the worst year by far ever. So you had the worst decade followed by the worst year, and the ratio of value or low growth to high growth was also at the co-equal highest, widest it had ever been with 1974. And the outcome after 1974 for value was wonderful. So I would look at the intersection of those two ideas. If you could buy the value stocks in the emerging market universe, which after all includes...
Which you can, right?
Which you can, and it includes some very high growth potential countries like China, and collectively they will have a higher growth rate than the developed world, almost certainly, and they sell at a huge discount. I would say they are modestly cheap in an S&P world that is extremely overpriced. And you could lock them away for 10 years or 20 years and really expect a decent return, which I would recommend. And since there is no hope of persuading people to actually get out of stocks, that would be the best I could offer. But for those 3 people out there who have a will of steel, I would say also have a cash reserve of 20 or 30%, as much as you can psychologically bear, to take advantage of much cheaper prices sometime in the not too distant future. Low growth emerging markets, as much as I could stand.
All right.
and a cash reserve as much as I could stand. And if you had 70-30, 30 cash and 70% cheap emerging markets, that would be a pretty resilient portfolio, I have no doubt. For the next 10 or 20 years, though, I think the S&P, of course, will underperform, just as it had a tough time from 2000 to 2010, where it had a negative return. And emerging markets, incidentally, beat it by 11 or 12% a year compounded.